A broad rally once again led by value stocks, lifting the Dow and S&P 500 this Friday afternoon. Well, let's get some investment advice for these choppy markets from Barron's Hall of Fame advisor Ron Carson, CEO of Carson Wealth, joining us today from Scottsdale, Arizona. Welcome back, Ron. It's been a while.
Hey, Fred. It's great to be back. Nice to see you.
Good to see you, too. Now, Ron, stocks have struggled for direction this week. For those of your clients with money on the sidelines, where in equities are you putting it to work?
Well, first, Fred, we should take a moment and just think about the last year, because I'll make a point with where to put money. Just imagine a year ago if I were doing this interview and I said, here's what I can guarantee you is we were going to have the economy shut down. We're going to have basically almost a civil war take place. We're going to have all the BLM movement that we had and all the unrest we had in the country. And I said, the market's going to make new highs, right? No, they would have probably laughed at both of us and said, you got a crazy man, on your show, which I think one of the things that investors have to remember is the markets are impossible to outguess. The market will do whatever it needs to do to prove the largest number of people wrong at any given moment. Always has, always will. So if we know that and we truly believe it, then getting your risk budget right is critical, like irrespective of what's going on, because what I've learned in my 30 some years in this business is the markets are a staircase with a yo-yo. You're going up, you're going to have volatility, but every day we have billions of people. We're growing in population. We're growing in our standard of living. We're growing in our ability to purchase. So we can get so caught up in the day-to-day. But if you can remember that as an important piece, because when I first got started in my profession, I got so influenced by what everybody was saying that I made a lot of short-term movements that didn't provide value for me or for my clients. Now I think we need to shift to saying, let's get the risk budget right before we even think about how to find allocations to fulfill our personal risk budget.
So what allocations have you set right now for your, say, average client, equities, fixed income, or within equities itself?
Yeah, so with equities, I think it's always appropriate to have more equities in the portfolio than most people are comfortable with, because I look at it a little differently. If the world comes to an end, like if you have a well-diversified portfolio and a world comes to an end, what's it going to matter? Truthfully, right? And fixed income is an important diversifier in the portfolio. Right now, it's hard to get any yield. I love to say you're getting return-free risk. You're getting plenty of risk, but you're getting no return. When I was in the business, it was treasuries were, your risk-free return. So it's just the opposite today. However, we've gotten the fixed income and interest rates wrong for so long. Is you still need to have some duration. I really like corporate high yield in here, which you can get a 4 to a 5% yield. And I also like a Best Buy, value stocks. Best Buy is yielding 230. They've not had the big run up, like a lot of companies had. They've really grounded out. They've done really well, through this environment. So I wouldn't be afraid to supplement equities, really some high quality value, along with corporate high yield, and then munis. Munis are also doing pretty well in here. And here's what's nice is you can do a 5 to 15 year muni bond ladder, AAA or higher, general obligation. So making sure you got lots of security around it. And as those bonds, because you do a ladder, as they roll over, you're going into whatever the rate is. So you can really protect the portfolio, but you can get a pretty decent yield right now, especially if you're in the high tax bracket. That's where I'd be looking for fixed income, but don't be afraid to hold high quality companies that pay a large dividend as well.
And you mentioned Best Buy as a value stocks. What about the allocation between value and growth? Have you changed those allocations, or just purely barbelling?
It really depends on that. It's the junk value that's done well, right? If you look at what's really happening, those are hard to hold on to because you can have a 60-70% fluctuation in value, and most of our clients aren't looking for that. But I would start to shift, especially with rates moving up. Value stocks are really in a position to do better. They've done, relatively speaking, when you compare to growth, they haven't done so hot over the last decade. I definitely we're reducing our exposure to growth, increasing our exposure to value. But also, don't get really silly with this. I think the market's going up from here. I mean, we got a lot of stimulus, and I think, you can argue what kind of shape the rest of the world in, and we got all this debt. We do, but it's a relativity game. We have increased our cash 2.5 trillion over the last 12 months, nearly $4 trillion in dry powder. We got another 1.9 trillion coming. We were talking about a $2 trillion infrastructure package. Now they're talking, our transportation secretary is talking about a $3 to $4 trillion. We have, I remember reading about this possibility in fictional books, years ago, how we just, the world just prints. And so it is a relativity game. And, I think stocks are going to move substantially higher, but I do think you have to keep an eye on the door for inflation. Expectations right now around 2.5%. I think this time is going to be a little different. We've not had to worry about inflation for a long time. I think 2 or 3 years down the road, you need to have some real assets in your portfolio, because I think inflation is going to be back.
Tips
would be a great place to be. Yeah, minus if you don't want to go the real assets. Tips. Treasury, inflation protected bonds are a great place, great alternative to think about. But I wouldn't be afraid of high yield in here. Okay. 4 to 5% yield. You're getting paid well for the risk, and I just don't think there's much risk of these companies. The economy is going to be strong with all the stimulus.
All right, thanks for your optimism and the tips on tips and the other investment vehicles. Appreciate it. All right, thanks to Ron Carson of Carson Wealth. I'm Fred Katayama in New York. This is Reuters. Have a wonderful weekend.